Hi there and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy and I'm Senior Analyst for ETF.com. This week I'm talking with Ryan Charles, Principal at Kelley Hunt Charles LLC, an asset management law firm. Ryan, welcome to the show.
Thank you. Thank you so much for having me, Sumit.
Ryan, you worked on an application recently on behalf of FM Investments so that they could offer a mutual fund share class for their existing treasury ETFs. Can you tell us about that?
Yeah, no, I'd love to tell you about it. The FM and RBB had come to us, and we had spoken with them for quite a while. As you probably know, a lot of folks in the industry, in the traditional mutual funds, are exploring and interested in the idea of going into the ETF space. And so, we've seen two recent filings. You have dimensional, you have perpetual, and that's something that folks are looking at. And we've talked to a lot of people in the industry, a lot of constituents about that type of endeavor. Here, it was really interesting and crazy, call it, is you have an ETF manager that is just doing an incredible job and recognizing that they could benefit shareholders by creating a traditional mutual fund and utilizing, it's not a Vanguard copycat, but use a Vanguard model where you have a dual share class, the mutual fund and the ETF share class in the same fund. And so we've been doing a lot of work over the last few months on that. And now, as you said, it's been filed, and we look forward to hopefully collaborating with the SEC in order to put this out to market.
So as you alluded to, Ryan, this is kind of backwards, right? Usually you have the mutual fund managers trying to come into the ETF space. This is going the other way. Does this have something to do with getting access to the retirement plan space?
No, absolutely. So, the retirement plan space is really set up to accommodate traditional mutual funds. And, there's significant 6 trillion in assets over there. And, for FM and RBB to be able to offer up their product, the easiest route to do that is, going to be having a mutual fund share class. I mean, as you think about it, there's always a lot of different ways to do things. And, they could always launch another fund and other things. But if you were to say, just that one example, launch a separate fund, you lose the economies of scale that can be gained and benefit shareholders by having all the assets in one fund, in one pool. So, I mean, you're absolutely correct. I mean, one of the key focuses here is on trying to give folks in the retirement plan space access to this very unique product suite, which is a single asset, single issue treasury. So FM has the whole gamut. T-bill, of course, is the one that I think we think about the most and talk about quite a bit. And as you've alluded to, I think in the intro there, FM has been incredibly successful as a young manager launching and gaining a huge interest. And so, there's a belief there that the retirement space could benefit and would like to have this type of product in that wrapper.
That makes a lot of sense. So Ryan, you talked about Vanguard, and of course, earlier this year, Vanguard's patent that allowed it to issue ETF share classes of its existing mutual funds expired. What impact do you see from the expiration of that patent?
Well, I think the Vanguard patent expiring, in my opinion, it kind of is a ringing of the bell. We had, it's similar to, in my mind, Rule 6C11. Prior to Rule 6C11, folks had to go through the onerous process like we're doing with FM and RBB to get exemptive relief. And so with Rule 6C11's adoption, you had a ringing of the bell where managers had an easier pathway to the ETF space. And with Vanguard's patent expiration, we've had, again, like I mentioned, we've had a lot of conversations with managers, with trustees, with other constituents in this marketplace. And it was kind of a ringing that allowed people to, explore the possibility of a dual share class fund, and that dual share class being the mutual fund and the ETF. So, while there is a incredible interest, I think that rightfully so, the SEC is being incredibly thoughtful and very careful about how we move forward. The SEC and the Rule 6C11, it just happens that it was a Rule 6C11 proposal, the final, not the proposal, but the final rule. They laid out some of their concerns with this dual share class model, and their recitation of those concerns have allowed us, with our application with FM and RBB, to be incredibly thoughtful, incredibly direct, and address, what are potential issues for the SEC. So, it's very intertangled, the Vanguard patent expiration and of course our filing. And so, I'm going back to that. But, the SEC, if you look at it, there's some very important considerations. They talk about cash drag. They talk about the transparency of the portfolio, the daily disclosure of holdings. There's a discussion in there about cross subsidization and the worry that if you have the dual share class model, that there could be some harm to folks. I mean, ultimately, the real incredible thing about being in this space and this industry is that we all want to do what is best for the shareholders. And so we really, all are aligned. I mean, an investment manager, a fund, if they don't have a shareholder focus, it's not long-term viable. It's not going to be working. So, I think that it's right for the industry as a whole to try to come together and discuss these things and say, okay, how do we do this? I mean, the one thing we have is we've got Vanguard, like you said, their patent expired, but their dual share class model has been operating now for decades, for lots of time, and it's working, right? And shareholders are benefiting. So it makes sense to allow the marketplace to utilize that dual share class model so that shareholders would benefit.
Well said. Ryan, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Yeah, no, thank you.